What can stop inflation? Eroding my emergency fund. Imagine your emergency fund as a safety net for life's surprises. Now picture inflation slowly wearing that net thin over time. It's like a slow leak that can weaken your safety. To keep your emergency fund strong, you need to understand how inflation works. When prices go up, your cash buys less than it did before. If your savings account earns less interest than inflation, your money's real value shrinks each year. For example, if inflation is 3% and your savings earn only 1%, you lose 2% of your purchasing power annually. That means your emergency fund might cover fewer expenses over time. One way to stop inflation from eating away at your emergency fund is to move your savings into accounts that pay better interest. High-yield savings accounts or money market funds often offer higher rates than regular savings accounts. These accounts are still safe and easy to access, which is perfect for emergencies. But during times of rapid inflation, even these accounts might lag behind. So, it's smart to consider other options. Another effective strategy is to overfund your emergency account. If you estimate your usual expenses are $10,000 and you expect a potential 10% drop in value, save $11,000 instead. This extra cushion helps protect your fund if inflation causes prices to rise or if investments in your savings lose some value. It's a simple way to add safety without much ongoing effort. Investing in inflation-protected securities can also help. Treasury Inflation-Protected Securities, or TIPS, are bonds that adjust their principal with inflation. When inflation rises, the value of TIPS increases, helping your money keep pace. Series I savings bonds, or I bonds, also adjust their interest rate based on inflation, making them a good low-maintenance option. Both are government-backed and requiring minimal management. For longer-term needs beyond immediate emergencies, diversifying your investments can help. Stocks, bonds, and real estate tend to grow faster than inflation over time. Real estate, especially rental properties, can generate passive income and act as a store of value. Mutual funds and exchange-traded funds offer diversified exposure with little effort, but they come with more risk and less liquidity. To put these ideas into action, automate your savings into higher interest accounts regularly. Review your emergency fund size periodically, especially if your expenses or inflation change. Ladder short-term bonds or TIPS to improve returns without sacrificing too much liquidity. If you're comfortable with some risk, consider allocating a small part of your fund to income-generating assets, but always keep enough cash for immediate needs. Balancing safety, liquidity, and growth is key. Using passive income strategies like high-yield accounts and inflation-protected securities requires minimal ongoing work but can help your emergency fund stay resilient. Remember to reassess your plan as your financial situation or the economy shifts. By doing this, you can make sure inflation doesn't quietly chip away at your safety net, giving you peace of mind and financial stability.